Hello, my name is Bill and welcome to MindYourCrypto. Today we are going to talk about macroeconomics, the S&P 500, NASDAQ, the IXIC, US Composite Index. We are going to see many of these, and we are going to debunk some myths about the hike rates. Before we continue, do not forget to join our monthly subscription, Patreon/MindYourCrypto. Thank you so much for watching. Have a fantastic day. Let's start. So, what is the US Composite Index that we are seeing in the trading view? Okay, you can find it on trading view by simply clicking IXIC or USC Composite Index. Okay, so we are having the stock market index covering all common stocks listed on the New York Stock Exchange, including American depository receipts, real estate investment trusts, tracking stocks, and foreign listings. This includes around 2,800 to 3,000 companies, and it is similar to the NASDAQ 100 index, although the NASDAQ includes the 100 biggest. We are going to see what is it, but this right here index is a very strong indication that if we fall, for example, from the 200 moving average and we have a technical analysis, okay, on that, we are going to see that we are likely to fall even further down from here. Okay, and this might be the start of something more corrective. This is in general bad, and of course all of these macroeconomics that we are going to see in the logarithmic scale as well, they had just a very huge uptrend in all the way right here, except the 2002 and 2009. But if we take a look over the previous years as well, you can see that we are just only going upwards. Okay, we are going upwards, but we are finding huge corrections in the middles, and we want to see if this is one of the big corrections that we are going to have, or eventually this is another normal correction to get all the way back upwards. Let's go to the other one, and this is the M2. The M2 is the money supply, okay, and it is a measure of the US money stock that includes the M1, okay, currency and coins held by the non-bank public, checkable deposits, and travelers' checks. Also, saving deposits, including money market deposit accounts, small time deposits under 100,000, which are very important, and shares in retail money market mutual funds. So the M2 is a very good measure to see what is the money supply in the world. Okay, and of course it includes many actually countries, okay, over the world, and we compare it to the NASDAQ, okay, to the S&P, the NASDAQ, to see if we have an overvaluation in the money supply than the growth that we have, for example, with gold, okay, or with the stock market, for example, is going hugely above the overly, actually it is in an overly overbought situation, while, for example, the gold or other assets are remaining low. Okay, this is a huge gap. If you see the charts, there is a huge gap between the stock market and of course the gold or the oil. Okay, the oil graph. All right, so anyway, we compare this. It is a very important tool to see where we are right now. As you can see, the money supply is increasing, keeps increasing and increasing all the way right here. Okay, and of course the NASDAQ 100. What is this index, right? The NASDAQ 100 index is a basket of the 100 largest, most actively traded US companies listed on the NASDAQ stock exchange. Okay, that's why we are seeing the NASDAQ, okay, and we are seeing the stock exchange of NASDAQ because there we have the 100 most important companies. The index includes companies from various industries except for the financial industry, like commercial and investment banks. Okay, these non-financial sectors include retail, biotechnology, industrial technology, healthcare, and others. It does not include commercial and investment banks. Always remember that the financial industry is out, but we often see that to see where the real market is going, where the market is going to go, and of course if we are holding some important support levels or not, if we are into something more corrective like we had, for example, back here on 2008 where we had the first correction, huge correction on 2000 and the second on 2008. Okay, we want to see where this is all going. And finally, the S&P 500, which is the most important one, and most crypto economic analysts or economic analysts or macroeconomic analysts look, because it measures the value of the stocks of the 500 largest. This is why we call it Standard and Poor's 500. Okay, largest corporation by market capitalization listed on the New York Stock Exchange or NASDAQ. Okay, the intention is to have a price that provides a quick look at the stock market and the economy in general. Okay, whenever this is going upwards, we usually have a nice economy, right? Whenever this is going down, we usually have a bad. And now we want to see if we are about to retest finally the 200 moving average right here. Personally, for me, in the monthly scale and of course in the weekly scale, we have already retested it, and now we want to see if we are going to have another buying pressure at the 20-day and the 50-day MA or not. Basically, I'm going to just go into another factor right here, another myth, and then I'm going to study a little bit the S&P 500 and the NASDAQ. Now, the myth that we are having, whenever we have hike rates, whenever we are raising the rates, the US actually, the Federal Reserve raises the rates, we are having a crash. No, you can see that I'm getting this from Michael Wang official, and you can see that Fed warns of rate hike, we are going down. Fed raises rates, we are going down there, but Fed raises rates for the second time, we were just going all the way up higher. Look at that, from 2016 all the way up higher. Fed initiates quantitative easing. Fed 8th rate hike, and then we fall down. 9th rate hike, and then we go upwards. Okay, so you can see that whenever we have these, for example, the Fed hike rates or the rate hikes, it is not something that we are going down. Okay, it isn't simply telling us that, because it is a more complex system. We cannot assume only by the raising rates that we are the raising interest rates that we are going all the way up higher, okay, or all the way, sorry, further down, okay, or whenever we have good news, we are going all the way up higher. Okay, so this is just a myth debunking right here, and it is a very, very nice graph to debunk some myths about whether we have that. Okay, you can see the 30% drop that we had back on 2020, COVID outbreak, and then we have the correction going on, Fed warns of ending tapering and raising rates, and then we just got a little bit higher until we had the correction going on. Okay, so we are going to see, of course, a little bit the S&P, and I'm going back here to the S&P 500. I'm going to delete this one right there, and we are going to see and look that we are having the S&P getting rejected, and actually we are constantly having lower lows and lower highs. There are some times in the history where we went down the 200 moving average, for example, on March 2020, but we had the COVID outbreak. This was something that doesn't happen often in the history, okay, such as the pandemic, for example, right here, but it caused a breakdown, and then we went all the way upwards. At the same time, we were riding up until now the 200 moving average, until we fell down all the way right here in 2008. You can see that we had the correction going on. It looks very similar, but look at that right here. For example, back there, we had this lower low pattern. At the same time, you would expect right here to have a crash, but we had one last buying push until we went all the way down, getting rejected from the 20-day MA, 200 moving average, 20-day MA crossing down the 200 moving average, and then we fall down. Now, we do not have this cross at all for now. Okay, is it possible to have one last buying pressure before we go down? Yeah, it is. Okay, and find rejection on the 20-day or the 50-day MA, and then we go down. So the recession could be a little bit slower. Okay, so we could have, for example, the economy getting back a little bit back up at the 2023, and then the huge recession comes in after the 2023. We can see small gaps that might bring us, for example, some hopium, a fake hopium though. Okay, so you can see that the S&P 500 right here is standing at the 1200 moving average. There is also a possibility of just going all the way down, having the 20-day MA crossing the 200 moving average and getting rejected, and then the real financial crisis will start, and the real economical recession depress people all over the world, including many of us. Okay, many of us will experience this fate. Anyway, this is what a global economic recession brings. It might be the start of something more worrying. And that, okay, and we have the war as well. Okay, we have the war as well, that it is sitting on Ukraine and Russia, and we do not know how actually the outcome. We do not know the outcome of the war. But anyway, you can see that the S&P 500 right here, we can have both ways right now. Okay, the thing that I'm expecting right here, it is to have a little bit of the correction and to meet the monthly 200 moving average. This is what I'm expecting, to be honest with you. I'm expecting that we are going to meet the 200 moving average and the S&P 500 will go further down over the next few months. This is a little bit worrying. I'm not seeing any signs of hope right here for the S&P 500. I'm seeing actually that we are going probably to go further down to test the 200 moving average and go even further down. Okay, maybe it will be like the 2008, maybe even worse. Many people are calling that this is a huge market correction, that it's going to come and it's going to bring disaster worse than the 1939s. I really would love not to see that. However, you and actually me and none of us know exactly how the market will behave. Some people are saying that the Feds will stop raising the hikes and then this will bring a little bit back, a fuel back up to the economy, so the 2023 will be a little bit better, but at the same time this is going to be a fake out because of 2024 we are going to go further down. But then for the crypto market we are going to have the halving period of Bitcoin and things are going to get better for Bitcoin at least, and for crypto lovers. Crypto lovers, we depend also from the Bitcoin's halving. This is good, okay, but keep in mind that something more corrective might start. We have two ways: either we do something like this and we go down, or we just go straight down. The result would be the same, but I'm expecting a correction going on, but at least we are going to see how much longer this will be. How much are we going to wait? Is this going to be a quick recession and then we are back to normal? It's going to be a longer recession that can last over 3 years or 4, right? We have seen that happening even in the history before. Okay, nothing goes up forever, nothing goes down forever. Always protect yourselves, and the way that you should invest right now is by simply putting either little money every month that you do not care about, or what you can do is to wait further for the crypto market to reach the 2023 and then you invest more. I have many investing YouTube videos actually out there that you can check out on whether the altcoins will find the bottom. Thank you so much for watching. Have a fantastic day and see you soon. Bye.